Welcome to the 2025 Dialogue, a masterclass series by the HR Association of India. I'm Neha Jignani, and today we are diving into a conversation that couldn't be more timely. From chaos to compounding gains, navigating uncertain markets in 2025. We are joined by someone who truly knows how to make sense of the noise. Welcoming Abhay Maheshwari. Abhay is the founder and CEO of ASM Wealth. He's a chartered accountant and an MBA from Indiana University in the US. He has over a decade of experience in IT and financial services sector and international experience having worked in private equity space in Singapore. Abhay has been an active investor since his teenage years and has already seen two full market cycles. Along with his team, he manages over 150 crore in investments across mutual funds and direct equities. Abhay's goal is to empower people by teaching them about personal finance so they can choose the right strategies and advisors while not getting carried away by false promises, narratives, and misselling. Abhay, thank you so much for joining. It's a pleasure having you.
Thanks a lot, Neha, for having me. I think really volatile times, and if I could be of any help to the HRAI community, it would be really great.
Thank you so much, Abhay. Looking forward to this exciting masterclass. So, to begin with,
Same.
my first question to you is given the unpredictable and uncertain market times, I want to know how should new investors approach mutual funds in 2025?
Right. So, Neha, when we say unpredictable, right, and uncertain, it's usually when we say it, we mean that we don't know in the short term in which direction the market is going, and there could be some pain. But if you take the time aspect out of it, as Warren Buffett says, we mostly know what is going to happen. We just don't know when it is going to happen. You will see that Indian markets are sturdy over the long run, right? We've had multiple government changes. We've had even the Kargil war. We've had terrorist attacks, 9/11, as well as in Mumbai. We've had Brexit, and we've currently also having the Russia-Ukraine war, the Israel-Gaza conflict going on. So India is not new to challenges, whether domestically or internationally. And the markets, as if you see in the long run, they will come back and they will do well because they are not separate from the economy. And currently, I think there's a lot of rhetoric building because of the tariffs, but I think at best it will have a 10 to 20 billion dollar impact on India, which is minuscule in the context of a 4.2, 4.5 trillion dollar economy where we are headed, right? And that also, I think, may be pulled back in some time. So I think mostly it is rhetoric. And let's go back to history, right? In January 2008, the markets crossed 6,000, and after that, it didn't hit that same level for another 5, 6 years. Now, what happened is that by this end of the same year, the markets had less than halved. They came to around 2,600. Now, assuming you started investing at 6,000, at the worst time, basically, you would have still made four times on your money by today. But if you continued investing at all levels, you would even put in an installment at 2000, and that would have become, say, 8 to 10 times by today. I'm saying at a minimum level, right? So the best way investors can navigate this is by, having a staggered approach, continuing to invest and staying long and consistent, right? If you are solving for consistency and longevity, you will come out a winner. There's no question about it, especially in a country like India, which has huge tailwinds. And even in the global uncertainty, they are likely to gain market share from other players. So have a staggered approach, continue your SIPs, maybe even increase them as markets keep falling, and focus on asset allocation, have some debt, some cash, some gold, silver in your portfolio, because managing volatility will allow you to stay consistent. Otherwise, there will be, emotional and mental ups and downs. So again, stay invested for the long run, see it from a 5, 10 year perspective, and I think then this will look like an opportunity, right?
Sure, sure. Fantastic. I think that's a very powerful reminder, Abhay, that consistency often beats the timing. So you have to be consistent if you're looking at a long-term wealth creation. So thank you so much for that. My next question, Abhay, is SIP still the best options, or there are more strategies in given today's market conditions?
Right, right. So, frankly, Neha, SIP is usually good enough, right? But it's just so simple and it gives brilliant outcomes, but it gets boring for people. It doesn't provide enough intellectual stimulation, and hence many people end up discontinuing it. Also, what happens is due to, this basically in a way becoming a cottage industry with no entry barriers, a lot of underqualified people with vested interests have entered. And then if you do SIPs in the wrong products at the wrong time, they are counterproductive, right? If you start SIPs like the CIO of ICICI just recently said, if you did SIP in mid cap from 1995 to 2002, your returns would still be zero, right? Or maybe even negative. So, assuming we have the right kind of mutual fund selected or safe mutual funds like index funds,
Mhm.
SIP is decent enough. However, a better strategy is a step up SIP. So step up SIP basically implies that, say, you are investing 50,000 rupees per month
Mhm.
today,
Mhm.
and next year you get a salary hike of 10%. So
Mhm.
you even increase your SIP in proportion to that. So you
Right.
start doing a 55,000 rupee per month SIP next year, ideally little more than the salary hike because that allows you to get ahead of the curve. What this does is it solves for inflation in your later years, and it also allows you to reach financial freedom early if you can say get a 10% hike but still increase your SIP by 12%, right? That allows you to get ahead of the others. And I'll just give you an example. For example, if you invest 50,000 per month for the next 15 years at 12% returns compounded annually, you end up with a corpus of 2.52 crore.
Mhm.
Whereas if you step it up by 10% every year after starting at 50,000 per month and compound it at same 12%, you end up with 4.34 crore.
Right.
And that 4.34 becomes a very significant number in this case because 2.52 crore will not have the same value after 15 years that it has today. So I think step up SIP is the way to go. And if you have time in the market, you don't really need to try to time the market.
Right.
Solve, as I said in the previous question, just solve for longevity, keep stepping it up, and don't need to look at market ups and downs that much as long as the economy has tailwinds.
Right, absolutely. I think that really puts things into perspective, Abhay. Especially step up SIPs. I feel they are not just smarter, but looks like they are the game changer if you're looking at early financial freedom and keeping the inflation and
Absolutely.
being future ready.
Absolutely. So they are a wealth creation tool, Neha, and you will be surprised how much wealth even salaried individuals can create if they can just focus on their careers and just do this passively, right? They can create much more wealth than many active investors, to be honest.
Sure, sure. Absolutely. So, Abhay, my next question is how can investors avoid common emotional and psychological traps while investing?
So Neha, actually, I think this is a separate conversation in itself because there is so much on the behavioral part of investing and the biases, the fallacies that kind of trap investors. Uh, for example, there's a loss aversion fallacy due to which people are more afraid of losses than they are, kind of excited about gains. And due to this, people end up avoiding bets which actually are in their favor and they should be taking every day of the week. And, there are things like sunk cost fallacy where due to which people keep averaging their stocks as they keep falling down, uh, but because in order to set right an earlier mistake they made, but actually it may be falling sometimes due to a permanently flawed reason rather than a temporary glitch,
Right.
right? So, however, I'll give like few tips or points which investors can follow which will help them. I think first of all, these discount broking apps and many of these apps on our fingertips where we say the mark to market gains or losses on a daily basis really hurt investors because it spikes your dopamine up, and seeing it multiple times a day doesn't really help.
Right.
In fact, there's one study which said that there's a 93% probability of seeing a gain if you check it once a year, but there's only a 50 odd percent probability if you check it once a day. Now, what it does is by you checking it very often, the gains or losses won't change, but you will be affected, and in turn, your decision making may be affected by, poorly,
Right.
and hence your returns may be affected going forward. So first is obviously keep watch lists instead of portfolios. Like use apps like Money Control. You just see a watch list. It's okay. You'll see it down, but you won't see the amount it's making a difference of. That helps. Second, I would say is please avoid trading in derivatives, futures, and options. Probably even stocks, because all the big, say, fund houses or have tons of analysts, managers working 8, 10, 12 hours a day studying these companies. There are so many moving parts,
Right.
right? So if you are doing this for the thrill or out of intellectual stimulation, then you need to spend that amount of time and do your fundamental and technical analysis. But if you are relying on tips, it may be a really bad situation. And this is, kind of evidenced by the fact that even though the Nifty has gone from 100 to 24,000 in the last 40, 50 years, most people you will come across have still lost money, right? That is counterintuitive, but it is because of bad behavioral habits.
Right.
And, coming to most people losing money, I would say the third point would be please don't let others' experiences affect you, be it your parents, friends, relatives, etc. Their experience is theirs. The time was different, the methodologies and the styles they may have adopted may be poor, like I said, taking tips from others. But don't let their baggage be yours. You can create your own journey, which is good. And this multi generational trauma regarding wealth creation and money should not pass from generation to generation. So please break that cycle if you can. And one more is that today, as I had spoken in the first question, that there are so many advisors in the market. So please filter them out, see people who have qualifications, because there are really no entry barriers here. You just, don't need to give too many exams or stuff, just small things to do. And, you know, giving it to random people who are the first people you come in touch with may not be the best idea. Evaluate them. Don't get carried away just because they are under some institution like a big bank or a big broking firm or something like that.
Mhm.
Finally, the banks and broking firms have to make profit, so they won't hire really qualified people. They may direct your funds to their captive mutual funds, and they have annual targets based on which their bonuses and incentives are decided. So your money is not any safer it is with them. It's anyway a digital asset. So it cannot be stolen, be it with anyone. It's not like land or gold, which physical gold, which can be stolen. Even if it's with any random advisor, it can't be stolen. But be it random advisors or be it these big institutions, they will not be able to generate market beating good returns in tough situations if their asset allocation is poor, like they have done now. They are called out because of investing like left, right, center into small and mid caps. So just do not get carried away by the tag of an institution, and do not even go to your random street side brokers. Look for qualified guys with integrity.
Sure. Absolutely. I think those are quite an eye-opening truths there, Abhay. And I particularly like how the breaking down of those emotional and behavioral traps that often derail the smartest of investors. Be it, giving into the temptation to invest into something or checking your markets on a daily basis. I especially liked your advice on looking at an advisor who can, help you make an informed decisions. So thank you so much. That was very comprehensive. My
Yes,
next
thanks,
question,
Neha.
Abhay, is are small cap funds worth the risk, or investors should always play safe by going with the long term, large cap funds?
Well, I'll answer this in a slightly different way. I'll start by saying what I do, right? So I personally like to choose different sets of managers with different kind of strategies and allocate my money to them, and then give them the flexibility to decide on their own between small, mid, large caps. The strategies may be different, be it growth or value or momentum or growth at reasonable prices or quantitative, but you need to know which manager stands for which strategy. And all of them in a market cycle will have couple of bad years, mostly good years, but it will even out, and as a bunch they can give you market plus 3, 4, 5% returns.
Right.
And it takes the burden of your head from moving from small caps to large caps to mid caps, because they are on top of the game and they can obviously shift. And for them to be able to shift, you need to invest in their flagship funds, mostly flexi cap, but some even focused or business cycle funds, I believe. And I'll tell you why. Because the market moves in cycles. There are cycles which are favorable to large caps, there are cycles which are favorable to small caps, right? And for us to keep chasing those cycles and moving between them, you will first have to sell from one fund, move into another. That will have a tax impact. Your capital will get affected. The compounding will be slower. Whereas in a mutual fund, if the manager does it, you don't have to pay the tax on that. Also, what happens is that there's a possibility of going wrong. And even if, say, you predict a small cap, for example, a small cap cycle is going to come and you invest in small caps, which fund will you choose? There are 20, 30 small cap funds in the industry, and most of them will underperform their benchmark an up cycle many times. And the same with large cap, right? Now, with small cap funds, another constraint is that, say, the small cap fund has a total of 10,000 crore asset under management. It performs well, gives a 50% return, and it goes to 15,000 crore. More people now pour in money because, people have seen the fund has a good track record. Now it goes to 25,000, 30,000 crore. What it does is that now at 30,000 crore, if you have to allocate even 2% of your capital, you need to allocate 600 crore. Now, small cap companies between 5,000, 6,000, 10,000 crore, they may not even have so much liquidity in the system if you want to buy 600 crore worth, right? Because you are effectively trying to buy sometimes 10, 15% of the company's total shares, and there are not enough sellers. So if the price is quoting at 200 rupees, you may have to pay 220, 230 to attract a reasonable amount of sellers. So you end up overpaying.
Right.
And similarly, when you want to sell at, say, 300 rupees, there may not be enough buyers. So you may have to cut it down to 280, 270 to attract buyers. So that is the constraint with small cap funds. Even if they perform well, after some time they will start underperforming as per certain basic concepts of math. So as I said, you know, use the cycles, but don't try to be extremely opportunistic. Invest in managers rather than small or mid or large, because there are good and bad quality companies in each of those indices, and you cannot be on top. In fact, even the managers, despite spending all day every day, go wrong in predicting many of these cycles, and hence we have our money across various managers. So for us to try to predict this and be on top and to try to time the market is extremely bad. Seeing funds as small, mid, large, you don't want to even kind of hold the manager to a mandate, because what it does is, if the manager, again, as I said, spots that it's a time for large caps, in a small cap fund, he or she still cannot buy too many large caps, right? So you get into good flexi caps, focused and business cycle funds, is my recommendation. And choose managers rather than small, mid, large. Defer the decision to smart guys who spend time in the market to choose between small, mid, and large for you.
Sure, sure. Abhay. So, uh, I think having a balanced approach is very important. And also, I could gather that trusting good managers with flexibility can also help you navigate in these uncertain times when it comes to investing. So, thank you so much.
Absolutely.
This brings us to the last question for this masterclass today, Abhay. What are the top three things to check before investing in mutual funds?
So, not an easy question to, put three parameters only, but the top three, the first and foremost, I will say, is the manager's style and track record, right? As I said, we need to know which style he or she is following, whether it's growth, value, momentum, etc. And we need to see the managerial track record, because if we see the track record of the mutual fund and say we are seeing, okay, 15, 17% average returns over the last 10 years, it's a great fund. But if the manager has changed 2 or 3 years ago, or the set of managers have changed, they usually may have taken even some of the analysts with them to where they have gone. So the performance of the fund may not continue in the future because the people driving it are not there anymore. So I think that is the first thing. The second, again, as I said in the previous question, is the size of the fund. It is increasingly difficult for the fund to keep outperforming its benchmark or the market once the size assets under management cross 30, 40,000 crore. Now there are exceptions here and there, but the norm is that size becomes the enemy of returns, right? So I would always recommend, do not see extremely small funds which are like less than 1,000 to 1,000 crore, because there may not be enough liquidity when people start pulling out their monies. But just do not invest in very, very big funds, except maybe the exceptions here and there. And the last, I would say, is check the DNA of the asset management company, be it HDFC or Kotak or Barak Parekh or Quant or Motilal Oswal or whatever. There are those who are extremely commercial. They are sales engines. They will tell you to invest money even if the markets are extremely stretched and overvalued. They will invest aggressively. And then there are, and they may even be poaching managers left, right, centers from other places. Now there are other firms, which even ethical ones, which even stop taking money from investors if they feel it is not the right thing to do for a particular scheme. Or they may say that we will not take lump sums, we will only allow you to invest monthly because now we feel it will be difficult to generate returns in the short term from these levels. And there are firms which groom their analysts to become managers, they handhold them. They are not, they only release new schemes when they see that even the investors can gain, and not just as a fad or fashion, right? So completely opposite, right? And that shows in the returns over a period of time. In the bull run you will not see this, but as Warren Buffett says, when the tide goes out, only then you can see who was swimming naked. And it becomes extremely clear. And when you are investing your money, you want not just someone with skill, you want someone with skill plus integrity, and that allows you to sleep peacefully. And these are the qualitative factors. And one more thing I would just add is focus on asset allocation, right? Don't just go all out into equities. If you have a lump sum, maybe spread it out over 6 to 12 months. Invest some gold, silver, always. Sometimes multi-asset hybrid funds also help. So risk management never hurts, right? So that's the again, checking the DNA of the fund house, how much freedom they give their managers, are they binding them tightly?
Sure.
So that also plays a part.
Sure. So to summarize, there is checking the manager track record. There is fund size, which plays a crucial role. Then there is the skill and integrity of the company that you're dealing with. And lastly,
Absolutely.
yeah, absolutely.
Asset allocation.
Asset allocation is the last point. So thank you so
Yeah.
much. Well, this brings us to the end of the masterclass. Thank you so much for sharing your insights and perspectives. I think you've given us some practical approaches in navigating these uncertain times, and also your emphasis on long-term investing gave a fresh perspective, and I'm sure our listeners are going to greatly benefit from your insights today. Thank you so much.
Thank you so much, Neha. Thanks for having me. And, as I said, it would be great if I can be of help to members of HRAI in these turbulent times. So, really appreciate you having me here.
Thank you so much, Abhay. I'll just have a quick note to our listeners. Thank you so much for tuning into this masterclass. If you enjoyed today's conversation, do not forget to subscribe and leave a review. Until we meet next time, let's continue making informed choices and turning financial chaos into compounding success. Thank you.
Thank you.